All right. So we are told there, Xeon Limited, a public limited entity, is in the process of finalizing its financial statement for the year ended 31st October 2021. Now that is the question where we add all those transactions, because we are handling 1 year's financial year, or rather one year financial what year items. So the following information has been extracted from its accounting records for the purpose of estimating the deferred tax balance. Number one, or rather, I would rather in this case here start with the required. So they want us to compute the relevant temporary differences. So number one, we start with inventory. Inventory is stated in the financial statement at the lower of cost and net realizable value. Lower of cost and net realizable value, that is which international accounting standard? Which captures inventory, which tells us that we should always look at how much did it cost you? What is the net realizable value? And then you take the lower. It is IAS 2. You guys are right. It is IAS 2. It is IAS 2. Thank you very much. All right. So we are told here, the company wrote down inventory by shillings 120 million to a net realizable value of 1130 million. The reduction in value is ignored for tax purposes until the inventory is sold. Temporary differences, I know what I need. For temporary differences, I know I will come and have the carrying amount. The carrying amount. I will have in this case here the taxation base, and then I'll have a column for temporary difference. All right, and the first item we're being given here is inventory. Inventory. So then I would want in this case here somebody, of course, the carrying amount. Ladies and gentlemen, please listen and listen to me very well. Carrying amount. We shall look at the cost vis-a-vis the net realizable value, and we take the lower as our carrying amount. We had bought these goods expensively, but we have realized that there is some kind of what here loss in value. So we have net realizable value, the lower one. The lower amount will be our carrying amount. So carrying amount, ladies and gentlemen, is not in debate. As per IAS 2, carrying amount in this question, the carrying amount for this question will be 1130. 1130. 1130. So are we together first of all up to there? Are we together first of all up to there? That carrying amount is 1130. Carrying amount is 11. Are we together up to there? No, they have refused. Carrying amount is the lower of cost and net realizable value. As we are done, a write down, isn't it? We are done a write down. Then I'll be able to explain, no worries. Then when you look at the next thing, we are told the company had wrote down its inventory by 120 million to a net realizable value of 1130 million. Before I explain what students want me to explain, the reduction in value is ignored for tax purposes until the inventory is sold. The inventory that you have here has not yet been sold. So there is no way the taxman will allow you to do that write down. The taxman tells you, you fine, we know there is a write down, but come now next year, when you sell those goods, you should be able to recover that expenditure from your income statement. But as things are, why are we calling this inventory? It's because those things have not yet been sold. They haven't yet been sold. So it means, ladies and gentlemen, that for the taxman, that 120 is disallowable. The 120 is disallowable. So I should be able to do what here? Add it back to get a tax base. So what are we getting there as our tax base? So 1130 plus 120, that gives us 1240 here, 1250, 1250, 1250. Allow me to explain something small here, ladies and gentlemen. Remember these inventory items. The inventory items, they cost us And then we have net realizable value. Net realizable value is what we are booking here as 1130 because they subtracted 120 to this net realizable value. But the cost of these items here was what here? Was 1250. Because the 120, you add the 120. And the IAS2 is very, very straightforward. It tells us that whenever it comes to you ascertaining the carrying amount shall always be a comparison between cost and net realizable value, whichever is lower. So in this case here, the one that is lower is our carrying amount. So the carrying amount is 11 what year? 1130. Is 1130. So I hope now I've been able to explain somehow in a way that you guys have been able to pick it. Is that okay? Can I move on to something different? Or do you want Mwalimu to continue in this case here, doing more and more explanations really? Great, thank you very much. I repeat again, somebody is saying repeat again. Do you have the question paper? Because you have a question paper really, I think it's a straightforward thing. It's a straightforward thing because you see here, we have this 1130. 1130 is after the write-off. A write-off of how much? 120. So if you add back that 120, then you'll be able to get that 1250. 1250 is the cost. 1250 is the cost. I would want really to repeat this severally, but in the interest of time, please. In the interest of time, I believe when you look at this thing later, you'll be able to understand it. I'm 100% sure of that. We go to the next item. Number 2. Trade receivables had a carrying amount 450. Great examiner. He's already giving me the carrying amount. So in this case here, we have, ladies and gentlemen, receivable. So receivable, they're telling us the carrying amount is 450 million. Carrying amount, I'm not going to make an adjustment there. Carrying amount is 450 million. After making a general provisions are disallowed always by the taxman. I hope that is normally what you learn in advanced taxation. We can only allow specific allowances. General allowances will always be disallowed. Is that you add back? Thank you very much, Barke. It's a general provision for doubtful debts of 30 million. This provision is not allowed for tax purposes. This was an easy, good examiner. It's not allowed. So in this case here, what do? We shall add it back. So then can you kindly give me the tax base? Give me the tax base for this receivable. The tax base for the receivable is 480 because it's 450 plus that 30. 480. So is that okay? Ladies and gentlemen? Ladies and gentlemen? Great. It's straightforward. Add back. Even if I don't understand a lot, add back. If it's not allowed, add back. We go to the next question. The next question, number 3, it's PPE. Has a carrying amount. I mean, this kind of an examiner, I mean, I would want in this case here to even hug him if I meet him. Why? He's giving me everything all right. He's telling me PPE, carrying amount. He's a good examiner. He's a good ninja. So PPE, carrying amount is how much? PPE. If you're together, PPE carrying amount is how much? PPE carrying amount is 450. Yes. PPE carrying amount is 450. No. Where did you get the 450 from, my friend? Where do you get the 450? It's 3050. So you are saying that the examiner is good and you want to confuse yourself. 3050. And a tax base, I mean, a tax base of 2750. He has even given me the tax base, imagine. 2750. Can even stop there. 2750. During the year ended 31st October 2021, property was revalued upwards by 150. This can never affect my temporary differences account. Revaluations, they always go to the deferred tax account. If I were you, I would have written somewhere in my mother tongue that revaluations only affect deferred tax account. That is the end of PPE. When we'll be doing deferred tax account in Roman 2, then we shall be able to bring those things of what are revaluations, either downwards or upwards. All right, ladies and gentlemen, if you allow me, I'll be able to go to the next item, number 4. During the year to 31st October 2021, development expenditure is normally capitalized and taken as an intangible asset. Development expenditure is an intangible asset, and they're telling us there, amounting to 480 million, was capitalized. Amortization of shillings 20 million was charged to profit or loss for the year. So, ladies and gentlemen, I would want a very bright student to tell me the carrying amount of this intangible asset known as development cost. Known as development cost. Market cannot never not remember to get carrying amount, you're taking cost minus any accumulated depreciation. For intangible assets, you don't call loss of value depreciation, you call it amortization. You call it amortization. So we shall subtract, getting carrying amount. We shall subtract, we shall subtract, we shall subtract. So it shall be 480 minus what year? Minus 20. 480 minus 20, which gives me 400 what year for carrying. Remember, this thing of adding back is not applicable really here for carrying amount, no. So in this case here, we have 460 here. Because remember, anytime they want us to get carrying amount, we as an accountant, what should we think about? Number one, we should think about carrying amount being equal to the cost. The cost is 480 minus any loss in value. Minus any loss in value. Now, ladies and gentlemen, what do you know about intangible assets regarding tax base? I can see they are saying 0, which is very true. Give me a reason. Why do we take the tax base of intangible assets, including goodwill, to be 0? Why? 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 I hope you're not just cramming. Why? 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 But unless we are told otherwise, there is a very good reason why the TBE for intangible assets is normally 0. It's normally 0. They don't generate profits, no, no. But, already accounted for at the beginning. Good arguments, but no, no, no. Based on CA, no. It was capitalized, no. Ladies and gentlemen, you must have been told by your tax teachers. Most of these intangible assets are those assets that the taxman would want to incentivize you. All right? The taxman would want to give you as an incentive that particular what year allowance. You enjoy it in full because you know you are making an investment. If, for example, you develop this product and the product gets into fruition, you start selling, so the taxman will be happy to receive profits and, of course, taxes later. You'll receive profits yourself, pay taxes out of them later. So the taxman will always want to incentivize you by giving you that allowance in full in the year that you incur them, in the year that you incur. So if you have gone to town and acquired a very good space and you paid goodwill, 20 million, the taxman would want to allow that in full, So it's basically encouraging you to get into that business. So the allowable automatically becomes the whole of it, So the whole of it, so that in future, you will not be having what year? You will not be having any taxes to claim now. The tax base, ladies and gentlemen, here for intangible, not unless you're told otherwise. For intangible assets, the tax base, if I were you, again in mother tongue, I would have mentioned in this case here very well, very quickly, the tax base of intangible, those assets that you cannot touch. You cannot touch. The tax base is what year? Is 0. Tax base is 0. The tax base is 0. So are we together, first of all, up to there? Even if it means you've crammed. Even if it means you've crammed. Even if it means you've crammed. Great, great. Thank you so much. Thank you so much. So we got the next one. The next one is, actually, they have already even told you this question. They told you in this particular note that this development expenditure was allowed for tax purposes in full during the year. Not many examiners can ever tell you that, because they expect you at this level, this particular exit level, advanced level, they expect you to be knowing those things that I'm explaining. They expect you to be knowing those things that I'm explaining. So, ladies and gentlemen, go to the next one, which is number 5. Trade and other payables are carried at 600. Included in the other payables are accrued expenses of shillings 100 million, whose related expenses are deductible for tax purposes on cash basis paid. So for these payables, is there anybody who is able to give me the carrying amount? For the payables. Is there anybody who is able to give me the carrying amount for the payables? So in this case here, we have 600. Carrying amount, 600. How about tax base? Abracadabra, abracadabra. Great arguments there, great arguments there, great arguments there, great arguments there. Great. The difference I'm being told there is tax what year? Is tax deductible? I can see people are really fighting there, which is very good. They would want to give you exactly 3 minutes. You think through this very well. Think through this very well until we see, in this case here, who will be able to give us the correct position. Is it 500 or is it 700? Please give us the correct interpretation. Give us the correct interpretation. That will really make me very happy. So I'm giving you exactly 3 minutes or even 5 minutes for our break. Because once you understand that, you have understood this very well. So we shall come back at 3:25. At 3:25. All right. All right, it's 5:20, I mean 3:25. Can we continue? It is 3:25. Are we back? 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 I'm so sure those 5 minutes have been very helpful, especially for those youngsters who are not taking lunch. I'm so sure they must have used the 5 minutes here to eat like ninjas. Very fast. All right. All right. All right. So then I should be able to continue. I can see now we are back to our number. Great. Yeah, Black Ninja eats very fast. The Black Ninja eats very fast. So, ladies and gentlemen, that English is very, very easy, really. That English is very, very easy. The English is very, very easy there. That English is very, very easy. That they are telling us that well within that 600, there is an amount of 100, which is included there. Remember, tax base cannot be zero for the whole thing, no. It's only 100 that is included there that can be claimed on a cash basis. On a cash basis. Let's read this thing. Let's read this thing really. It's only 100. It's only 100. So the entire tax base cannot be zero. I rule you out of order if you're saying zero. I rule you out of order if you're saying that the entire tax base is zero. Now, if you look at note number 5, trade and other payables are carried at what year? At 600. Are carried at 600. So carrying amount, no problem. But now included in the other payables are accrued. What do they have accrued? Expenses of 100 million, whose related expenses are deductible for tax purposes on cash paid. So you ask yourself whether that cash has been paid. If cash has been paid, then we'll say in this case that those expenses have been deducted. Cash for those expenses has not been paid. That is why we are calling it payables. At the end of the day, they are outstanding. So then what you need to do is to go ahead and deduct that 100. Perhaps come next year when that payable will be made, that 100 will be deducted next year. But here, it cannot form part of our tax base. It cannot be, in this case here, allowed. So ladies and gentlemen, then, remember, in the 600, we have 100 inside it. So the best thing to do is to come and deduct that 100. Is to come and deduct that 100. And then, of course, if it's a liability, there are two ways. You could either put this as a negative, or you leave them this way, and then at the end of the day, the final answer you get, you'll multiply with -1. Because it's a liability. 0 for the 100, that's a very good student. 0 for the 100. So then, ladies and gentlemen, are you able to give me now this temporary? Because that is the last item. Are you able to give me the temporary differences? That is the last item, remember? So like, what is the temporary difference here? It will be 1130 minus 1250. 1130 minus 1250 gives me how much here, somebody? 120. 120. 120. 120. Negative, right? Is it negative? Negative, eh? Negative 120. Thank you very much. Thank you very much. From there, ladies and gentlemen, come to the second item. 450 minus 480 gives me negative what here? Negative 30. Go to the next item here. 300. 300. Go to the next item. This is 460. 460. But now we have the last item, which is a payable, a liability. 600 minus 500 is 100 positive, but I have to negate it. I have to change the sign. If I don't like that approach, you can put this as negative here. So that gives me negative what here? Negative 100. So then are you able to give me the total here? Is there somebody who can add and give us the total? Is there somebody who can add and give us the total there very easily? Why are we adding? Because all these transactions belong to 1 year. All these transactions belong to 1 year. So the total is 510. Positive. Positive. So it means that we are the ones who will be liable to KRA. If it's positive, you take this like your profit. Of course, you'll not be able to pay this amount this year. It's deferred. You'll be paying in the future. So it's a deferred tax liability. It's a deferred tax liability. It's a deferred tax liability. So can somebody in this case here go ahead and give me the deferred tax then? Is there somebody who can compute the deferred tax for me? Is there somebody who can compute the deferred tax for me? Is there somebody who can compute the deferred tax for me? So deferred tax. If they have given us the rate, it's very easy. It's 30% of 510. 30% of the total temporal difference. So 30% of 510 gives me what here, somebody? It gives me 15.3. 15.3. Ladies and gentlemen, with that, is there somebody who can, with that, is there somebody who can give us a deferred tax account? Is there somebody who can give us a deferred tax account? Is it 15.3 or 153? $153, 30%, 153, yes, 153, 153. Now, ladies and gentlemen, remember here, before I answer Abraham, remember here, this will be my balance carried down. This will be my balance carried down. This will be my balance carried down. So as I do a deferred tax, account, balance brought down. In the question, they gave us a balance brought down in which note number? Is there somebody who can see the balance brought down in some note number? Anybody who is able to see balance brought down in some note number? Note number 6 as 272. And remember, it's a deferred tax liability, and as such, I'll bring it down on the credit side. On the credit side. If it was a deferred tax asset, I would have put it here. So we have here balance brought down is 272. And you ask yourself, of course, balance carried down is this 153. But before you close the account, in this question, we have a revaluation. Do you remember the revaluation? What is the revaluation amount? There was a property, plant, and equipment that was revalued upwards. By how much? By how much? 150. It was an upward revaluation. So if it's an upward revaluation, then automatically that increases your tax liability. So in this case here, we have revaluation tax. $45. So can somebody balance this account? Can somebody balance this account? Can somebody balance this account? So this is 272, 317. 317. 317. And then we have an income of 164. So P and L. Oh, you this gentleman or lady is telling me that she would have, in this case here, missed to tax. It's a revaluation tax. It is a revaluation tax. All right. So how about, at times the examiner will tell you, give us journal. Give us the journal entries. Give us the journal entries. Out of this, are you able to write the journal entries? So let's first of all journalize the profit here, this profit here. So the profit. So I will debit like what I've done here. I'm debiting my deferred tax account. Debit deferred tax account. And then I'm crediting the P and L with 164. 164. Of course, you can see here, we have debited the deferred tax account. Deferred tax account. We have here the deferred tax account. We are debiting. And then, of course, you are debiting this account, then you are crediting the P&L. Are we together, first of all, here? Are we together? Are we together there? Are we together there? Are we together? Great. Thank you very much. So from there, we have this revaluation tax, 45. So revaluation tax. Good question there. Why are we taking, in this case here, revaluation tax on the credit side? It's because automatically, later on, because of that revaluation, as you realize your assets, later on, you'll be required to pay tax. So it is an increase in tax obligation in the future. If it was a revaluation down, then I would have debited that revaluation tax. But these are revaluation upward. Most of your questions are revaluations upward. All right. So before I answer the other questions, ladies and gentlemen, come here. So revaluation tax. Debit. Credit. So here I'm crediting the deferred tax account. Was it 45? 45? No, Dominic, you are cheating me. I can't debit. You know this tax element. I can't debit tax on PPE, really. That would be like you're increasing your PPE with taxation. Debit, revaluation, I can see you guys are running away from me. So we debit revaluations account. Revaluation surplus account. It doesn't go to the P&L directly. It doesn't go to the P&L directly. It has to go through the valuation reserve or surplus account. Evaluation reserve or surplus what year account. Now, this gentleman friend of mine called Abraham is asking why is something like goodwill, for example, being given a tax base of what year? Not unless you're told otherwise. Any intangible asset. Intangible assets are assets that have what we call long-term impacts in our business. These are those items that will occur today, and then yourself and the taxman KRA will be so happy in the future. And the taxman would want to encourage you to do research and development. Like if you tell him you're doing research and development today, he will tell you, fine, incur 10 million and go ahead and deduct that 10 million in the year that you have been incurred. So in this case here, for the taxman's, from the taxman's angle, any expenditure that has got long-termism, and there are many, those expenses, there are many, like marketing is one of them. We have training and development. Is another expense that you're required here to, cost is required here to, which is allowable. You are required here to expense in the same year. So marketing, those research, goodwill, etc. I hope you'll be able to remember that in your exam. Intangible. You know, remember, something like marketing, you normally don't take it to the income statement. You're supposed to capitalize it and take it to the balance sheet as an intangible what year asset. I believe I have really done my best. And remember, the essence in your exams, the essence is not you to go and get these questions like 100% correct. The essence, and I'm encouraging you, is to ensure that you have as many entries as possible being correct. Or is there anybody who is looking for perfection in your exams, forthcoming exams? So long as you have like 5 out of 7 entries correct, you'll be given all there. Because it's very costly. It's very costly to be perfect. It's a very, very costly affair. If you're looking for perfection, it is very, very costly. If you're looking for perfection, even in marriage, if you look for perfection, you'll never get married. You'll never get married. But of course, I'm not using that to run away. Imagine, Vero, even, even with these many entries being correct, you will still bring an award home. Bring an award home doesn't mean that you get 100%. No, no. And fortunately, I've shared with you the marking schemes. You've also seen that the marking schemes of the AFR is not about the final answer. They'll just mark tick, 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 and then they'll say any 7 at 2. So you end up getting all the marks, even if your final answer is wrong. Is that something that you guys were able to also see from your marking scheme? Is it something that you were able to see from your marking scheme? Actually, if you want an award, awards are normally gotten by students who are quite fast in these papers, quite fast in these papers, quite fast in these papers, quite fast in these papers. All right, so we're getting awards. That is very good. That's very good. Ladies and gentlemen, please look at part 1 of this question. They wanted us to differentiate between temporary and the permanent differences. Is there somebody who can give me the difference between those two? Those two, very good terminologies. Temporary and the permanent differences. Temporary and the permanent differences. Remember permanent differences, ladies and gentlemen, are the 4P and the L items, if you remember. Remember, we have got profit and loss, method of deferred tax, and we have got balance sheet method of deferred tax. When you're doing income statement method, ladies and gentlemen, if there are those items that you're comparing in your income statement that you, as the accountant, has allowed, but KRA does not allow, then those differences will be called permanent differences, because you will never claim those taxes in the future. So for example, when you are getting your accounting profit in the year, you are arrested by city council askaris, so they took you and of course threw you in that particular bad lorry. They took you to City Hall and you are forced to give them 50,000, either legally or illegally. You see, for you as an accountant, you will pick that amount as a fine. So they say fine is 50,000. But does the KRA, will KRA be able to allow you to deduct that 50,000 fine? No. So any expenditure that is disallowed and you are making use of an income statement approach, ladies and gentlemen, then that expenditure automatically, the difference will be permanent, because you will never be allowed in the future to claim anything from that difference. That difference is permanent. It's irreversible. It's irreversible. There is nothing that will turn tables in the future. Temporary differences, of course, is like what we have seen, ladies and gentlemen, here. First of all, before I go to temporary differences, is there somebody who can give me this definition of temporary differences? Temporary differences, is there anybody who is able to give us that definition, really? They are not talking to me. I don't know why. I don't know why. Thank you very much. Whenever you are describing temporary differences, there must be that formula of carrying amount minus tax base. That formula must always be there. If I'm marking and I don't see that formula, then automatically I'll not be able to give you correct there. So anytime, ladies and gentlemen, you are talking about temporary differences, please look at this, and you have to take a screenshot. Temporary differences. Temporary differences arise when there is a difference between the carrying amount of an asset or liability in the financial statements and its tax base. But this difference will reverse in the future. The difference will reverse in the future. Example, one common example of a temporary difference is the depreciation of an asset, like the first question that we did with you. For tax purposes, the government may allow faster depreciation than what a company uses in its financial statements. Of course, that would mean that your carrying amount, because you used depreciation, will be different from what the taxman has, the tax base, because the tax base you used in this case here, wear and tear. We expect in this case here there to arise a difference, but that difference is temporary because at the end of the day, we must align. We must go to zero. We did a very good example with you, which took us to zero. So this creates a temporary difference because over time, the book value and the tax value will align. And then we have permanent differences. Permanent differences, on the other hand, are differences between the taxable income and accounting income that will not reverse in the future. It's based on disallowable expenses for income tax purposes, e.g. fines, general provisions, etc., 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 like that. All right. So, ladies and gentlemen, I think if I'm to stop there, I will say I have done something not very good, not very bad, but at least you guys have been able to pick something. But I want to make some announcement. If you allow me, some announcement regarding our classes. So as I make this announcement, there is something that I would want to draw your attention to. And there's something that I always tell you, but unfortunately, most of you guys don't take it very seriously. This time you don't take it very seriously. So are you able to see my Excel sheet? Are you able to see my Excel sheet? Are you able to see my Excel sheet? There are things I normally get even my bosses at times. Things I normally get even my bosses at times doing in Excel, and then you wonder. So for example, if you are given this kind of an Excel sheet, and then they give you these three values in this case here to add. So you'll get a ninja, and he's an accountant, a funny black ninja, will come and start telling you that to add this thing, take summation. They start writing like that, they tab. So they come and take this like that. And then they smile as if they have done something very big. Ladies and gentlemen, please listen. If you're a great ninja and you happen to be having things like this, this is how we normally get summation. What you're supposed to do straight away, if you want to sum that, you're supposed to talk of alt equals. So when you say alt equals, you can see alt. I'm pressing on alt down permanently, and then I say equals. You can see I'm able to get there something, the formula coming automatically. And then out of now this, I should be able to tab. So when I tab, I get the total here, and then this cursor goes to the right. And when I'm on the right here, now to get the right answer, because already Excel has been able to copy the formula and it has moved to the right, what I need to do is to come and give them a control right. So I say control R. When I say control R, this thing gives me the total automatically. Ladies and gentlemen, we are moving to a very, very important era, which is based, or rather known as the knowledge economy era. Agrarian revolution iliisha, industrial revolution ikaisha. Sasa saizi tumeenda digital. There is no way you'll tell me that as an accountant, you are doing things in a very, at times I even laugh at them. And every day I must get people doing silly mistakes, silly Excel mistakes. And I'm gonna tell them silly. Because you'll get, for example, somebody has got something like this. All right. Somebody has got something like that, for example. All right. Just allow me to write several of them. All right. Let me come back here. Great. So you can see in this case here, this is a situation where we have words which are spilling over. When you have words which are spilling over, what I've seen these black ninjas doing, you'll get a black ninja who comes here and then they tell you that they're stretching this row at this column to become wider for the whole term now to fit. I really laugh at them. So what I do, I tell them a very simple thing. Hey, you ninja, what you're supposed to do to become a white ninja, come here and highlight the entire sheet. When you have highlighted the entire sheet,
come anywhere on top here, anywhere. It can be like between B and C at the column, and then you double click. Every other word now, the cells in this case here become bigger, and all the words in this case here are able to fit simultaneously. Let us be very honest with each other here. Do we have anybody who has been a black ninja who has been expanding those things one at a time? Please don't hide. I'm your father, remember. I'm your father now. I've turned 45. Most of you are 22 years, 21 years old. I'm your father. Tell me the truth. You know, you can cheat every other person. You can cheat your mother. You can cheat every other, but you can never cheat your father. Your father must be told the truth always. Always. Great. You can see I've got very, very, very ninjas. Black ninja has been doing this every day. So great. So that is why we have not introduced, but I've been always having these Excel classes that we teach. In this case here in December. So from December 12th, immediately after your exams, we'll give you like 4 days to relax. And then you start doing Excel classes with us. Those Excel classes, we are charging how much? Is it 2,500? 2,500, and then we shall be able to teach you the entire Excel and what we call the Power BI. Power BI for doing graphics here and there. So there is an early bird discount for those guys who will be able to pay 2,000 bob. Will be able to pay before end of next week. That's Friday, Saturday. They'll only pay 2,000 bob, and then they'll be able to do what you have to enjoy those Excel classes that I teach in person. So I hope that is a good deal for you guys. I hope that's a good deal for you guys. Python class will come in later. So I'll be able to, do you have a discount? Yes, 500 bob discount if you're an early bird, ninja. Great. I need a refresher. Great, that's very good. We shall overcome. We shall overcome. Now, because we are talking of these classes, the ones we are calling, in this case here, low-hanging fruits, which we are starting tomorrow. You guys say that AFR should be in the morning. So if it is in the morning, then we are starting tomorrow at exactly 9 with AFR. Is that okay?